Hi guys, and welcome to another edition of Talking Finance with Dan. Today's topic is retirement funding and what's changed. On the line, we've got Richard Chesworth from Household Capital all the way from Sydney again, joining us to have a quick chat about this matter. Chesy, how are you, mate?
That's right. I'm well, yourself.
I'm fantastic, mate. Fantastic. Let's get into the meat of the conversation as to why we're here today. Chesy, we've known each other for a while. But can I just go into for the audience to know how long you've been
Yeah.
involved in retirement funding?
Look, I think my exposure's really started in around 2012, but that exposure then took me back to around the pre-GFC retirement funding, reverse mortgages, as we commonly talk about retirement funding, right through to now. So, my real periods was seeing an old book of reverse mortgages pre-2008, then a portfolio from 2012 to 2017, and then the pleasure to start with Household Capital in 2019 as we launched into a market which has had probably a lot of changes over that period.
Mm-hmm. Now, it's pretty interesting to note you've been saying the word retirement funding rather than reverse mortgages. Because look, I suppose you'd call it I grew up, but for the majority of my time in finance, I knew it as reverse mortgages basically. Any sort of I suppose tale or conversation as to why it's not reverse mortgages anymore, but it's retirement funding?
Look, I think perception and reality are quite different. The reason is, particularly in people finance and advice and everything, they may talk reverse mortgage and they straight away picture something. As in my previous role, where I'd be talking about a number of offers to brokers, including reverse mortgages, you'd pick the body language, and the body language would start to shut off. But once you start explaining the solution, and when you look at it, reverse mortgage is really it's really a regulated part of the NCCP. So it's rather than a forward mortgage. We don't always talk forward mortgages in comments, and so reverse mortgage is basically other features and solutions and protections for customers to reflect a remortgage. So we're very much here talking about retirement funding, because as we get older, and we all are, that period becomes closer and closer, and just because you turn 60 doesn't mean you stop working and the like, so there's a need there. And so we're looking at very much shifting the terminology to retirement funding, but having the supports of the NCCP, which is that no negative equity guarantee, your lifetime tenancy, so the term of these loans really reflect the life of the person living in the house, and those different controls around lending values. I think the other thing to call out is, with all the changes, we'll probably touch on a few as we go through here. We've even, through Household Capital, we had our third pillar forum recently. And we even had Peter Kell, and that name would be familiar to many of you as the Assistant Commissioner of ASIC a number of years ago. And his views on reverse mortgages and retirement funding being one of the most regulated consumer products out there in the market. So that's very much why we've shifted away from talking reverse mortgage, because we're focusing on the solution rather than just the features of the product.
Awesome. Now, on a previous interview I've had with you, you mentioned that more people right now in their 60s are actually still working and actually have a mortgage, versus someone in their 1980s, whereas most of the people in their 60s would have no mortgages. Do you see any other changes so far in the market with regards to this?
Look, I think there has been a lot of changes. And if I go through these segments, I think first of all, the pre-GFC period, you had less controls. There were fixed rates. People caught with fixed rates. There was a lot of lenders in the market, and the outcomes delivered to the customers were probably a shorter term view, higher lending values, and probably more of a risk and uncertainty on the customer. Then we went into the post-GFC period. And in that period there, we saw an increase in regulations because it actually formed part of the NCCP. But we've really seen a shift in participants. So a lot of um, the major lenders have actually stepped back from the market, also because of the specialist nature, and it's challenging to manage that through a broader branch network in understanding the sensitivities for some people, vulnerabilities, and also the needs of an older client. So we've seen the major lenders step back, but that post-GFC period, there's probably still a focus on that short to medium term needs. But what are we seeing now? We've had an asset review come out through on reverse mortgages. It's very much, again, being cognizant of vulnerabilities with people, managing that through. But the biggest focus is now, it's very much on preserving the equity, preserving that household equity for future needs. We've got an enormous ageing population issue in Australia. We've got an enormous care bubble ahead, so it's using that, preserving that equity as much as possible going forward. And then it's also getting that greater focus on the long-term needs of the customers. So it's shifted from short to medium terms to that long-term approach now of how we're looking at managing people's needs.
Excellent. So then, how are you guys managing it? I mean, as in household capital and your business primarily being with regards to retirement funding?
Yeah, a couple of ways. We're a purpose-led lender, so it's very much rather than just saying, here's your lending value, just go and borrow, and the next thing you know, someone may go and, for example, I think a good example is someone will go and buy a new Mustang, and they might be 65, 70, and they've always wanted the Mustang, but they've also got a few back ailments and movement issues. And after 6 months, the novelty wears off, and they've just forked out $90,000 on a car. And 6 months later, they're going, this isn't working for me, and they're going to trade it in, and they'll be getting $65,000 for the car. So we're very much a purpose-led lender. We lend for cars, travel, holidays. Our real key focus is on identifying the needs and lending to those needs.
I was just going to jump in, probably not holidays for the short term that we're in a pandemic at the moment.
True, although we're in a beautiful country, and if we can get our own borders internally sorted out, there's a lot of places to go. But the overseas trips are probably off the table for a while. Yep. But it's very much that focus on making sure we work with the broker and the customer in preserving that household capital for that future needs for the client down the track. And I think the other thing we've really had a focus on since we've launched this market is through a household loan, which we provide, which has the fundamentals of the reverse mortgage with compounding of interest. We've been really focused on making more affordable lending and more affordable funding there to reduce the erosion of equity in the house. So we've continued to do our part in driving interest rates down in this segment here. What we've also done is provide the customer the flexibility of, if they want to pay interest, they can pay interest. And we do that more so through BPay than direct debit. So they've got control over when they switch their payments on or off. So if they've had a lot of bills come in some month, they may decide, no, we're not going to pay our interest this month, because they never have to. And then if they want to pay interest, they can, because we have a lot of people coming to us saying, yeah, I still want to pay interest on this loan. And it's very much we encourage people, if they want to pay interest, to pay it. Or you might find the kids go, I prefer to pay the interest on the loan, or we'd like to pay the interest to stop that erosion of household capital from mum and dad. So we build that factor in too. So it's through BPay to give both the borrowers and their broader family, if they wish, the flexibility to cover that along the way.
Fantastic. So now brokers don't tend to come across many retirement funding needs during their average year, basically. How do you make it easier for when they do come across those sort of situations?
Yeah, so rather than meddling through and working out, okay, how do I do this loan? What are the things I've got to check off? Who do I have to talk to? Managing the process. We're very much engaging with the broker market on a spot refer process. So through the finance and coffee page, we've got a referral portal there where we collect key details. We give the broker a call in the first instance to discuss, the initial scenario. If there's much there, we then contact the customer and we manage it right through from the initial inquiry right through to settlement, refinance, purchase, whatever we're doing there. We keep the broker informed of the milestones. We do the work with the customer through the application process. We do all the fact find requirements. We provide all the projections under the ASIC guidelines, and we cover off those future needs. And at settlement, we pay a referral fee to the broker as well.
Well, that's pretty awesome because I was going to say that's pretty awesome because obviously as 2021 hits with the introduction of best interest duties, the amount of work that a broker needs to do any loan is monstrous. Let alone that I'm assuming the average the average retirement funding loan size has not changed since I last worked with you at Macquarie Bank in around about 2015, I think it was. Yep. The average loan size was probably only 150 at maximum, isn't it? So
yeah, generally, look, you see a lot of smaller ones, then you see some larger needs, and you do get some big ones once in a while. But in saying that, generally, I think you're comfortable in saying the average loan is that $70,000 to $120,000 mark. So then you look at the time and effort as a broker you put into managing a need like that, which you may come across once, twice, if you're lucky, 3 times a year, compared to how many home loans do you do a year or a month? How many investment loans and the like? And that's your knitting, that's your core business, and you want to do that well. And the challenge is sometimes when we have something out of the ordinary hit the table, it's actually trying to fit that in with our general workflow.
Well, thank you, Richard, for your time today. For the rest of the audience, basically, if you haven't yet registered on our website, go to www.financeandcoffee.com.au. Go into the referral section and find Household Capital if and when you come across a client that needs retirement funding options. And Richard and the team at Household Capital can assist you there. Richard, thank you again for your time today. Very much appreciated, mate.
Thanks, Dean. Thanks for your time.
No worries.